Good morning.
Whoop, whoop. Good morning.
Good morning.
Yes, you are tuned into Talent Talk. This is what we do. We're Talent Real Estate. John Scott Talent Real Estate. We are here today to bring you news on real estate and what's going on in the market. And today, if you saw the banner, what are we talking about today? We are talking about, are we in a housing bubble? Is it about to burst? Is it about to pop? What do you all think? Are we at risk for a housing bubble?
I don't know. That's what we're talking about today. Is the market going to fall out? Are we in a housing bubble?
Good morning, Donna.
Good morning. Yeah, we
A
get
bunch
that
of henny
question.
pennies here.
Well, why don't we introduce ourselves because we have another face on the screen with us today. A little cute
good.
face. How come our heads are so big at the top and then they're really little at the bottom?
Huh?
No, like you and I are like big heads, and then Steve and Pat are like little heads.
Well, we can change that. We can stack them. We can swap them. It's kind of like the shell game.
Well, Jurgen, you're Jurgen. We all know Jurgen.
I am Jurgen. Yes.
We've missed
And
you
you
the
are?
last. Yes, I'm Davina. And hi. And
I'm Steve.
Good morning. I'm Pat DeWees.
Yes, and Pat is a realtor. She also is our branch manager for our Olympia and Tumwater offices, and she is an amazing lady. And so since we're talking about we have like the realtor management team on the screen right now, and so I think we're like, okay, so are we qualified? I think I think we know enough. And we're kind of going through this together, and so we get the question all the time, are we in a bubble? And we all are homeowners, and we all are navigating through this season as well as helping our clients. So I think we're in for a really good treat today.
When the question gets asked, like you talk to somebody who's in real estate, and what did they want to tell you? No, of course not. That is, but why? If it's not, why? If it is, or if there are things to be watching for, then we want to let you know. And that's what we're actually going to end up covering today is, if we're not, or if we are, what are the reasons behind it? And if there are changes that we should be looking for down the road, stay tuned because we're going to give you the optics that you should pay attention to as the year progresses or as the market progresses.
Yeah.
Well, I guess the question is, what is a housing bubble? Like, people say, are we in a bubble? And like, what is that?
If I was in a bubble. Oh, go ahead, Steve.
Bubble. Whenever I think about it, it's like housing bubble. It's like a bubble. You blow bubbles, bubbles rise. Just like in housing markets, prices tend to rise and go up. And they talk about there's a lot of things that play into, the prices of homes and that bubble rising. And that's kind of what we're going to talk about today. I mean, because we've seen several housing bubbles over the past. One, the housing bubble, which we had here recently within the last decade and a half. So,
decade and a half. I know time flies.
Yeah.
I know it does. It does.
Right. And so when we think about bubbles, it's like they get to a point, when you're blowing that bubble with whether it's a piece of gum or you've got that wand of huge bubble, and eventually that bubble gets so big, and what happens is it will pop, right?
Yes.
So, that is, what happened back in when we had the housing crisis, and the elements of things that happened then, are not necessarily the elements of the things that are happening now. And so people are asking, are we in a bubble? Because we're seeing, price appreciation, markets where things are going, and, the property sold before the post even goes up, right? That was what was happening then. But are we in a bubble? And if we're in a bubble, is that bubble going to pop? And so I think those are two good questions. The question is, are we at risk for a bubble? But are we even in a bubble right now?
And one other piece of context in there too is just understanding cycles. Real estate is like many different industries out there. There are cycles to the market where the markets rise and the markets fall a little bit. That's not a bubble. Traditionally, real estate operates in nearly 10-year cycles where it goes up a bit and then it comes down a little bit. It goes up a bit, just comes down a little bit. But when talking about a bubble, we're talking about an abnormality where it continues to grow and grow beyond the point where it might shift or just do these little slight corrections, which is what the cycles do. When it goes adversely large, at some point there's that pressure that you guys were talking about where it builds to a point where it can't sustain, and then the bubble pops.
Yeah.
So are we, Davina, Steve, you guys were mentioning it, is that what we're building into?
We are we building in? Well, we are building into that conversation right now, and there are some things that we're going to talk about. The answer to that question, I don't know if we want to answer it up front now or we can answer it at the end, but the differences in
I think it's
where we
appropriate.
were.
Yeah.
I think it'd be appropriate to answer because it's going to give context to the things that we're talking about, the differences, and why we would come to a conclusion that feeling doesn't always give you that. We have to go back to the facts and the things that are actually happening to draw good conclusions.
Yep. And I honestly, before we get into it, I would like to ask if you are listening and we want to know what are what are some of the things that you're concerned about? Like, well, if you're live here and we can actually see your comments and kind of talk through, we're going to be talking through this. Like, what are you most concerned about in this housing market? Whether you're sitting on the sidelines watching or whether you're, actively looking or thinking about selling or, family members or whatever, what are you most concerned about in this market? We'd like to know what that is. So please share your comments with us. And we probably, you're probably not alone, right? So.
No.
But
just for the fact we're having the conversation means
exactly.
you're not alone.
Exactly.
Yeah.
So Pat, are we in a bubble?
That term to me means a little bit different than I think it does to a lot of folks right now, having gone through what was termed a housing bubble, 2008 to 10, 12, whatever, in different areas of the country. It came up at a different point in time. This does not feel the same as that. So I'm going to say I would not call it a bubble. Bubbles burst. I don't really feel that we are in a point of burst. So my answer to that is no, I don't believe we are. But I do believe that we have a lot of things that we can share today that will give some context to what that might look like and help our viewers, our audience know what to be watching out for.
Amen. Yeah, we agree. I think you are definitely on the right track. And I think one of the things that is different is that led us into the bubble last time that is totally different now is lending criteria.
Mm-hmm. For sure.
There's a lot for us to talk about. I think Pat and I, we talked about this before. We were both, in homes and had those ugly loans that were literally the biggest issue of packaging those bad loans and selling them. And, let's talk a little bit about how lending criteria was and is now that is not contributing to the bubble factor.
Well, one of the things I would, chime in on is the fact that we are not looking at loans that have adjustable rates. As you alluded to, Davina, that was one of the things that was very popular at that time. And for those of us who were self-employed, or those of us who were adding to perhaps having a rental property or doing some other things, or just moving up, we don't have those. And I mentioned yesterday, and the comment that I have said to many people is that when we were doing these, we talked to lots of people, it felt as though the lending criteria was so loose that you needed a heartbeat. And I don't mean that in a disrespectful way, but it just seemed like there wasn't much background or criteria for those loans. And it got a lot of us into jams.
Sure. They actually had signature loans where they didn't have to verify anything at all, which is crazy.
Mm-hmm. Yeah, it's called stated income, right? You just state what your income is, and okay.
Yeah, I'm making this much money, and yeah, here you go.
Yeah.
Yeah. So
Nobody would ever not tell the truth on that, right? Like Boy Scout.
Right.
Yeah. I think it was
that would be I think people were just the lenders, and people were just walking around like this, right? Don't tell me, I don't want to know, right? And that was, people went to jail, right? Like,
yeah.
You remember, at least for me, one of the examples that stands out, there was a lender, a local lender in the Puyallup area who went to jail, and he actually had a safe in his office with stacks of cash in it that he would give to people to help them out with their loan. And it was just, it's crazy. I didn't know about any of that obviously at the time, but as everything washed out, we found out all of the different things that were going on. For the vast majority of the market, people were doing things the right way. But for a lot of people, enough people to cause a bubble and a burst, unfortunately, there were enough people that were taking advantage of loose guidelines,
right,
that it led up to that.
Or no guidelines. I mean, it was bad. I mean, credit scores didn't matter. It didn't matter about income. All the thing that mattered to the consumer was the payment, and the lenders were literally on these adjustable rate mortgages. Were doing, there was one called an option adjustable rate mortgage. It was called an option arm, and that's where you had an option to pay a lower interest rate. So literally, you talk about interest rates low. So they'd say your interest rate is 1%. And we're like, 1%. You only have to pay a 1% interest rate. But that's just what you have to pay. You have the option to only pay 1%, but your real interest rate was like 8 or 9 or whatever it was.
Right.
And so you're paying this 1% interest every month, but the other 7% interest is getting added onto your loan balance every month. So your loan is growing by thousands potentially of dollars every month. And you're only paying a very small percentage. So as the market changed and values went through the floor, now you owe more than what the home is worth, and you owe even more because now you've been adding onto your mortgage payment or your balance, instead of your balance normally being reduced every time you make a payment. So that was a big problem during that time as well. So
absolutely.
When you say that, it also reminds me that there was part of that bubble pop. It's different because you were talking about rising, and then we talked about cycles. Cycles are almost like little hills. They go up and down. But a bubble is like a cliff, like a going up the mountain and then coming to a face, and you just drop right off. What also happened in addition to all that is they recognized when this caused the Great Recession, or helped lead into the Great Recession, that these practices for all these different financial companies were so out of whack.
Yeah.
So they introduced so many regulations. So the pendulum also went from one side where it was so incredibly loose that anything could go, the wild, wild west. Then it swung to the other side where it was almost impossible for a lot of people to even get loans. So, I mean, you also had this coupling of what was going on in the mortgage, not just before, but the reaction to afterwards caused a real just tightening of the market, because a lot of people that were able to get loans prior no longer could qualify, and they had to relearn how to qualify for loans.
Yeah.
One of the other things that happened too was the change in our criteria for appraisals, because at that time you could pick your brother-in-law, or you know what I'm saying, you could pick anyone you want, you could choose your appraiser, whereas now we have a system in place that is managed and done in a more appropriate fashion to keep us within the guidelines that we need to be in for that appraisal. So that's a huge difference to what it was like during this bubble.
Yeah. You saw regulations happen to all these interrelated and connected industries to real estate. Escrow. Some companies were buying trips for agents. You had lenders just tossing money around. There was so much, unfortunately, well, fortunately, unfortunately, whatever you want to say. I wasn't in when that was going on, but it was such a loose environment that unfortunately it was really ripe for a level of, I guess you could say, corruption.
Yeah. And when you mention the appraisals, that I think just getting, as Tom Ferry would say, unpacking that just a little bit, right? When Pat mentioned your brother-in-law or your cousin or whoever it is, the appraiser. So literally the lenders and the buyers are, and a lot of this time it was the lender saying, hey, we need this house to appraise for this. Because, understand that the housing market the bubble was growing so quickly that you literally, buy a house within a couple of months, it's worth so much more. So people were looking at very short time of, the short time with how things were growing. So the appraisers, the houses were coming in. There was no such thing as a low appraisal. It was, we need this house to appraise, make it happen. And the appraisers, and I will say this wasn't all of them, but there was a lot of appraisals that were happening that were just not, they weren't right. And so what was happening is these appraisers were being influenced, they were being threatened by the parties that were involved in the transaction. And many times it was the lender or the consumer. And so here you now have appraisals that are not accurate because of the fact that these appraisers were a lot of times afraid of not bringing the value in. And so there was, the prices just kept going. There was no ceiling, no regulations. And so that is what changed the regulations now, which is appraisers can't even talk to the lender before the appraisal, period. And the lender orders the appraisal, can't even order, they have to order it now through a management company. So there's a third party that is put in place, and the lender makes the request, and then the appraiser is assigned from this third party, a management company, and then the appraiser gets assigned, and then they go do their thing. So, the communication process is definitely changed. And we were finding, things got so stringent that it was like, in the lending process as well, as you mentioned, hey, you can't even get a loan now because the process. And now the appraisals were so tight. It's like, okay, then we started seeing appraisals, people being concerned that now appraisers are, not giving us the value because the changes had were in such effect. So we went from one end all the way to another end, but there was a big, huge consumer protection bureau came in, and lots of regulations happened from that.
Appraisers have to be able to defend the value that they put in there, and it has to be based on empirical evidence. They have to be able to essentially prove it. So it's frustrating sometimes when it's in an appreciating market because they have to use data that is historical, which means they can put a little weight into what's happening inside of the market. There is a little allowance for it, but they can't go crazy. They have to be able to show how those numbers are actually relevant. And it's not just that pie in the sky number that used to be okay.
Yeah.
Yep.
And that's kind of, one aspect of this whole equation. Why is it different? And if you guys have any thoughts on it too, put them in the comments. It's really interesting. That's one of the areas. The criteria for being able to get a loan or purchase a home has changed dramatically. It actually helped because it changed and shifted so quickly. It also, that change and shift also helped lead to the fall in the market. But as we do, we adjust, we understand, we learn, and then we help teach and bring people back up. So we've gotten to a real good balance at this point. So the criteria was one area. What's another area that is different this go round or makes it feel less like a bubble, but more like we're in a cycle that had a long way to recover from?
Steve was about to say something.
I'm just trying to think, the differences right now between the market back then and the market now. And one of the things I remember, there was a lot of speculation buying going on in regards to purchasing homes, and then knowing that I'm going to purchase this home, I'm going to turn around and sell it, speculating that the prices are going to go up. And there was a lot of that. And what happened was that happened fairly quickly. And it almost feels similar to the market that we're in right now. The only difference is right now we have a lot more stricter guidelines as far as lending. Appraisers are held to the standard of making sure that these homes truly establishing that value, as opposed to earlier, right before this crash, prices were rising like they are now, but those lending guidelines were so loose, and where was I going with this? They were so loose. You didn't need to have a job, and it was almost like a false value, and that was inflating these prices, as opposed to now there truly is a demand for homes, which is really pushing the price. But we also have stricter lending guidelines, regulatory people that oversee the appraisers. So there's that demand there.
Yeah, so Steve, you're kind of talking about one thing that's really different is then the buyer mentality of things. Like the way they were approaching the market at that time was very much in line that the prices are going to go up forever. They had these loans, these adjustable rate mortgage loans that they could get at an incredibly low price, with the expectation within 3 to 5 years they'll be able to refinance it, or better yet, they're going to be able to get equity while they pay just the interest on this loan. And then before that principal balance becomes due inside of there, they're going to sell it anyways for more than they bought it for, and they're going to buy a bigger house or a better house, or they're going to refinance it, and then they're going to get another home as a primary resident. Like, the buyer mentality itself has really shifted. And one other thing I thought about during there, right now we're having conversations about, hey, is the market sustainable? And we're having good conversation about what to be looking for, and just be aware that something can't go on forever. Like, what we're experiencing won't go on forever. But the conversation at the time was instead focused on, look at all of the new home ownership we have. We were celebrating that people who couldn't buy a home before, all these people are now buying homes, and home ownership in America is higher than it's ever been. But maybe it shouldn't have been. I mean, it seems to have proved out not everybody should be in a home. Like, I don't mean it in that way that it might have sounded there, but not everybody can afford to buy a home, or at least the home that they necessarily want right now. And there are reasons why you should save, and you should be able to be responsible so that you've earned that home ownership too.
Well, buyer mentality is also changed in the sense, back then, I remember if you were a homeowner, a lot of the investment, there are all types of, buy quick, buy now, and, use your equity. And they were saying, cash out all your equity. Like, we were hearing, pull all the equity out of your home because this is where the prices are, and like cash out, and then buy something. I mean, like, literally it was right before the bubble popped that people were literally pulling out, and they were doing 100%. So here's a lending thing. It was pull out 100 or 110% of your equity. So you could pull out more than what your home was even worth.
Yeah.
Which was insane. Now that's not happening now, because if you get a cash out, you still have to have like 80%, 80%, 20% equity left in your home to even do a cash out in many cases now. But they were saying pull out more than what your home is even worth. So if you have a home and is worth $400,000 or whatever, you can take out, $440,000, right? It's like crazy. They were lending more than what your property was even worth then. And I think the buyer mentality has changed, especially now, because people are buying homes because they need housing, not because they want to take advantage of the market, right? So that's a big difference as well. because people are thinking more long term in regards to, and I'm paying rent, and
Yeah.
the landlords are giving us notice, and rent's going up high, and we need more space, and we need housing. I'm tired of living with mom and dad, or whatever that case may be.
Davina, that leads actually into another area, actually, really naturally into another area, which is another contributing factor that is really vastly different is inventory. Because when you're talking about, uh, being more careful, and uh, a lot of people, like, inventory is incredibly low, and a part of that is if somebody does sell their home, there is equity in so many homes. Like 70% of the homes that are out right now under mortgages, under loans, have liens, whatever the case, 70% have equity. Like, it's a completely, it is really shifted and changed right now.
Mhm.
But if somebody sells their home, so many home sellers are afraid of how are they going to find a home to buy then?
Yeah. Yeah, that's one of the biggest concerns, is that people are not putting their homes on the market because they're not sure that they can get into the next one.
Yeah.
So that's contributing a lot to the inventory or lack thereof.
Yeah. I think that's probably one of the biggest differences right now when I compare like today versus previously, is that there is truly a supply and demand that has been driving the prices up right now. The shortage of inventory, and the demand by the buyer versus opposed to prior to, where there was not a shortage of inventory and people were just buying and prices were going up based off of speculation. It's almost like everyone felt like they were an investor. I'm going to buy today and leverage this property up and sell it for more tomorrow. And the thing is, they were doing that fairly quickly until the market dropped. Why? Because of the bad lending practices, people couldn't afford these big homes and these big mortgages that they were buying. So that's kind of like the big difference between now and previous. I mean, we just don't have that.
Yeah.
I mean, people can actually afford their homes that they're getting into.
Well, the lending criteria helps to ensure that much better than it did prior, because they're verifying everything along the way. I know, just recently went through the home buying process, and as a real estate agent and having self-employed income, how tough that was, and how trepidatious it was getting into underwriting and having to pull all of these things together. That was stressful.
Yeah, yeah, yeah.
But you walked yourself through that, right?
I walked myself into a wall like 20 times. I literally kept beating my head on a wall. It felt so hard.
Yeah, and the thing is, it's supply and demand. Truly is supply and demand. We just do not have enough inventory to meet the demand of the buyers today, and a lot of that has to do, and that actually brings us to the next one. Why is the supply? People aren't selling. They're not putting their homes on the market, so there definitely is pent up demand. So for every home, you've got multiple buyers, and multiple buyers are still floating around in the marketplace waiting for the next home to come out. So, we obviously are in a huge seller's market with double digit appreciation in our, with home prices. Contingencies being waived. I mean, it's a really tough market for a first time home buyer, and that's one of the reasons, is because there's still a lot of cash that is floating around in the marketplace, with um, the second home buyers. There's still the investors that are purchasing homes for rentals, or there's just people that have saved, and they've got their 401k monies, or they're moving out of one area that, where they were able to sell their home and get cash to pay for a new property. So we're seeing those first time home buyers having to compete with multiple buyers, which there's a ton of cash that's out there for large down payments and even paying for the property outright. So, we need more inventory, and and lending practices. Actually, we were talking about this the other day. Lending practices for investors has really tightened up, so where interest rates are higher, to help discourage more loans or investor financing and making it not as easy or maybe not as profitable for investors to purchase using loans, so that maybe it could give them a more an opportunity for primary homeowners to purchase. So
So, Davina, with that, we've actually covered, and there are more. I mean, when you start digging to 2022 is not, 20 or what, 2007, 2006, 2008. A lot of things are so different. And as you dig, you actually find a lot more differences along the way. We talked about the lending criteria, just the buyer criteria to be able to purchase, the investors, appraisers, the mentality of the buyers themselves, and just the lack of inventory. But you know what? There's reason to actually at least entertain the question or ask and be aware, which was not happening during the lead up to the last bubble pop, when it was an actual bubble, the Great
Right.
Recession. People were celebrating every day, and nobody thought it would ever stop, which is insane. So if
Mhm.
we're thinking about that, what are some signs? Because this is important. It's not all roses and rainbows out there. What are some signs? Like if we're going to watch and the market, even if we have little cycles going across, what are the things we should be watching for that could cause little shifts or corrections inside of the market? What are things we should be aware of?
One of the things that we do need to realize is partially it's our global scenario right now. It's what's going on in our world, not just in our immediate area. I know there are several people that I have recently come in contact with that have connections to um, Russia or Ukraine that are concerned about how that's going to pan out. So that's one area.
yeah, our global economy is definitely, I mean, you look at what's happening there is affecting gas prices, right? And it may not be a direct correlation to real estate, but it does trickle down into our real estate market and our practices, where we're looking at, people wanting to, kind of hold back and say, I don't know exactly what's going on here. But one of the triggers, honestly, too, is, looking at what's happening in the global economy, but also interest rates, right? So we're looking at, as interest rates increase, and the question is like, how much do they need to increase before? But we've been talking about interest rates increasing for forever, right?
Right.
Every year, I mean, we were in those twos. It even dipped down to like 1.9, and some people have interest rates that are sub 2%, insane. And there were still people that were sitting on the fence. It's like, hello, and now's a great time to buy. Go do it. And now interest rates are right around that, depending on their ish 4-ish%. And we've been talking about interest rates increasing, and they're supposed to increase multiple times during the year. So that's a huge factor. As you see interest rates going up, what would cause the market shift is it's going to cost you more money for the same house tomorrow if the interest rates are a quarter to or half of 1% higher. The affordability factor.
It may be the difference between what you being able to afford a home or not be able to get a
Mhm.
loan on a home.
Yeah.
Absolutely.
And we're seeing that today right now with several buyers, even within our office that put off and they were on the fence. And they were looking for a home. They were saying, I'm going to wait to see what the market does. Well, that cost them money, and the buying power that they have to be able to purchase a home. There was a little bit of regret there with some of these buyers that they didn't make the move, last year, even 6 months ago, with the raise in the interest rate. So there's a lot of factors that come into play when we talk about, purchasing. And one of the things I think about, and even here, is the job market, um, unemployment, and how that plays in. And we've actually the unemployment rate has been going down over the last several years. And with that, and with more higher paying jobs, people are able to afford homes. And because people can afford homes, there's that demand, and there is that lack of it. We still just don't have enough homes for people to purchase.
And Steve, actually, you know what? What's Valerie's got? I have buyers like that. That means they're on the fence. It's definitely time to buy before you become that buyer. Yeah.
Mm-hmm.
When you mentioned the jobs market, Steve, there are higher paying jobs. There are things, but what is counterbalancing that too right now? Inflation.
Mhm.
Because if as the cost of goods right now, inflation is outpacing the wages. So people may have made more, but they're actually able to afford less because the value of money has gone down. So I mean, all of these things interplay. That it's not there isn't a silver bullet when watching, being aware of what's going on. It doesn't mean there's one specific trigger that is gonna cause something else to happen. It's not this becomes this, but it's a accumulation of all the things. It all compounds
Mhm.
into creating a picture. So you really need to be aware of many different aspects and keep
Right.
your eye on them. No one thing is going to be the lever, but collectively they cause movement
Right.
if we're not staying aware of them.
That's right.
Yeah.
And also just keeping a track on, what's going on in the stock market also is an indicator of where real estate is or what could affect in the real estate market. You talk about mortgage-backed securities and um, you know, investors divesting in the mortgage-backed securities and going over to, different stocks, so we just have to keep an eye, whether it's the 10-year bond, which was kind of the or versus the 30. There's just a whole lot of different things that, and our again, we have a global economy, then what's happening in the stock market, and then also with interest rates and with the job, are jobs up or jobs down, what the unemployment rates are, can be indicators on where our market is. I think the good news is that there are indicators for that, and the good news is also that we are still currently in historic lows for interest rates. I
Yes.
mean, that's like, of course they've gone up, but historically they are still low. And for those buyers that are just on the fence saying, I'm just going to kind of wait it out, it's really a personal choice. Like, what is your housing situation? And are you in a place where, you're squeezed because your family is growing or, whatever the case may be. And it's not a decision on, whether you want to get a deal, right? It's a decision on, do you need housing? And if you need housing, housing is um, real estate is like the best one up. I feel like real estate is the best form of investment, and
Yeah.
it is an investment. Um, so you just have to make that personal choice, and you have to be able to understand that it's almost like a gamble. Should I stay or should I wait it out? You might end up pricing yourself out the market if you wait. That's
Yeah.
the bottom line.
So you know what? We actually covered a lot, and hopefully, go back, rewatch if you need to. Put
Yeah.
some comments in here as well because we love the feedback. And if there are things that we can, you want us to cover a little bit more in depth down the way, or if you have comments on how to, what you might want us to do better, hey, we're here for you. The conversation is a wrap up. Hey, we talked about what's currently going on and is it a bubble? It certainly doesn't feel like it based on the information and the facts of what's going on in the market right now. When we look at what had occurred previously with lender criteria, with the investors, appraisers, buyer mentality, inventory, there have been such shifts in qualifications, et cetera, in those areas that it feels like this is actually a natural function of the market rather than an artificially inflated market for there. But it won't go on forever. And what are the things that we should be watching for? We talked a little about interest rates, about jobs, inflation, stock market. There are a lot of factors just to stay aware of and keep your eye. You start seeing big shifts in there, reach back out to us. We'll help you get through the information. A lot of the news out there is about attracting your attention. It's about clickbait. That's not what you want to get caught into. You want to stay reasoned with your approaches. That way you can make a great decision. Davina mentioned it. If you need a house, now's a great time to be able to buy a house. You might have to compete harder. But if you need a house, it's still a great time in the market. If you don't need to do something right now, maybe you don't have to. But be informed, because then you'll make great decisions.
Mhm.
No. And
Absolutely.
if you have any questions regarding buying, selling, putting together a plan of action in order to do any of that, or investing, reach out to your local John L. Scott talent agent. We'd be more than happy to help you out.
Absolutely. And I know as we're coming up to a wrap, it's 5 minutes before the top of the hour. Want to remind you about our winter trip. That drawing is going to be happening at the end of next month. So basically, it's a $4,000 credit to go
The
anywhere.
world.
Yeah, right. There's a couple places you probably don't want to go right now, but anyway, it's a trip around anywhere. So get that form. It's on the link, or it's in our chat right now. Click on that, sign up. No purchase necessary, required to enter or to win. And then we have some things that are coming up today and this weekend. Open houses. We've got our Farms
Yeah.
Friday. Steve's gonna have to jump off in a second for that. I don't know what form are we going over today?
The buyers
Representation.
no, the
Advisory and a seller's market.
Oh, advisory.
Yeah.
Yes. Oh, that's perfect. Perfect timing for the things that buyers are doing and the risks that that you have to take and shoulder to compete this day. So join us for Forms Friday. All of the events, career night, March 22nd. Christy's got her marketing class, getting started with Google My Business and Canva 2. Oh my gosh. Lots of things going on. And next week, what's going on next week?
We're going to do an AMA. Ask me anything.
All
So
right.
bring your questions. We'll come prepared with a few. We'll be collecting questions during the week. And then if you're on there, we will also take questions live on the broadcast. So tune in. We want to talk to you.
Yeah.
Bring your best questions. If you have any information about what events that are coming on or happening in our talent group, just check out our events tab on our page and you'll get plugged in. So,
And
all right.
You don't have to just bring your real estate questions to the AMA.
Yeah.
Bring your question. You want to know a little more about us too? Bring those questions too. We'll go there.
Yeah, like why did we get into real estate, or what was your biggest fear? What was whatever?
Yeah.
We're all good.
Do you want to know my favorite color?
No.
Ask me.
I think
Just
we already
ask me.
know your favorite. I think we know your favorite color. We know
Yes,
Donna's.
but not
favorite
everybody does.
blue.
color. No.
Oh,
Oh man. So this is
Thanks for
great.
having me today, you guys. It was
Thanks
fun.
for joining, Pat.
Yeah.
Yeah.
Thank
Well,
you for that.
Do you want
All
to
right.
take us out, Pat? Explain what these two words are that are on the screen now and take us out?
Yes. So our mantra within our John L. Scott family is do the things that make you uncomfortable, step out of that zone of not wanting to put yourself out or be vulnerable. And so on the count of 3, 1, 2, 3, be bold.
Yeah. Have a great weekend.
Bye.